So what I want to talk about today is really directed to you passive investors out there, and it's kind of a buyer beware for the current market. So if you're working with a syndicator who brings you an opportunity to buy in a multifamily complex, some of the things you have to be careful of are the fact that right now cap rates are very compressed. So a multifamily complex that a couple of years ago may have sold somewhere in the 7 or 8 cap rate might now be selling for, or at least priced at, somewhere in the 5 to 6% cap rate. So you know, you're looking at a 5.5 cap that would have been 7.5 a couple of years ago, which now means that you've got to have a really good plan for increasing the rents, for upgrading systems, reducing expenses. So as a passive investor, what you need to look at are things like, are they being realistic about what costs they can cut? Are they being realistic about the rate increases that they're projecting and how much rent they can get in that particular area? Are they being realistic about their vacancy rates? And are they being realistic about the hold time? So it's my opinion that right now, if you have one apartment complex that is selling at a 5.5 cap rate, and there's a plan to upgrade over the next 3 years and then sell, the chances of that cap rate going from, let's say, 5.5 to 7.5 in 3 years is much less likely than if you invest in a property that is now a 5.5 or 5.5. And the plan is to get out in 5 to 7 years, chances are you're going to have a higher cap rate, which means the value of the property has not, mathematically, it's not going to increase much. In fact, it may not sell at the same price that it was purchased at. And so much of that goes into how are these syndicators planning on upgrading and increasing rents so that if there is some fluctuation, a little fluctuation in the cap rate, you're going to get your money back plus some kind of profit. There is a good chance that some of the people buying right now, quite frankly, are buying at such compressed cap rates that if they plan on holding for 5 or 7 years and their numbers were a little too aggressive, they may not be able to get the money back when they sell the property, which means that the investors may get their original investment back without any appreciated profit, or maybe they'll get less back. Plus, you have to realize when you're selling the property, you're going to have to worry about, is there a broker commission, and if there is, how much is that going to be, which is going to cut back on the amount of cash that can be taken in. So be careful if you're a passive investor of these things. Be careful about the rate that they're borrowing money at. Be careful about if there's mezzanine debt in there that's at a higher rate than is realistic for the complex. So it's just my caveat to you, passive investors. Take your time, look at the numbers, have them explain the numbers to you, feel comfortable with the amount of time that they are going to hold this complex before you get your original investment back and hopefully profit. So thanks, this is Mark, and I'll talk to you again soon. Have a good day.